Square, huh?
Hi, everyone. Welcome to Analyze Your Trade, episode number 23 for February 13th, 2018. Tonight, we will be discussing your trade ideas. And over the last couple days, about 40 people submitted up to 5 symbols each. And I put together a list of the most frequently requested ones. And you should be seeing that on your screen right now while I'm talking. So we're going to go through as many of these as we can and see what I guess for tonight have to say about that. My name is David Cosmeter. I'm the creator of Timing Research, and I developed the show with Dean Jenkins of Follow Me Trades, and he is here to moderate tonight, so I'm going to go ahead and turn it over to him.
All right. Hey, thanks, David. And thanks for our panelists for being here. I'm looking forward to it. We got a good list of symbols here. Some of these trades I'm already trading and interested in and watching. So I'm really looking forward to hearing perspective and comments from the other panelists. So let's kick off by having the panelists introduce themselves and just give a quick intro of who you are, what your approach to the market is. We'll go in alphabetical order, and your names both start with J. So I'll just Jim.
Okay, Dean, thanks, and nice to be here again with you. Basically, OptionProfessor.com got 7 DVDs explaining the ins and outs of all the option strategies, and basically, I'm the content provider for them, and we've been doing this for a long time, so that's what we bring is knowledge on the uses and the risks of all the different strategies that are out there.
Okay, we got the Option Professor live tonight with us. It is awesome. And John, the Mad Hedge Fund Trader. Yeah.
How are you? John Thomas, the Mad Hedge Fund Trader. We are global macro, long, short, cover all asset classes, stocks, bonds, commodities, precious metals, energy, and real estate. And we have a daily newsletter and trade mentoring service, send out about 200 trade alerts a year. And we are up 8% on the year so far, but I have to tell you, it's the toughest 8% I've earned in my lifetime. So you can find me at www.madhedgefundtrader.com. All
right. How could you not love a service called the Mad Hedge Fund Trader, right? I'd sign up just for the name. That's good. I am Dean Jenkins, founder of FollowMeTrades.com. I am a technical trader. I was a fundamental trader for many years and experienced extreme disappointment and frustration in that approach. I do check a few key fundamental things before I take a trade, but my analysis is primarily technical. I subscribe to the Benjamin Graham school of thought that in the short term, less than a year, or in a few months, the market is a voting machine driven primarily by emotion. And you can see patterns in the market, and I try to follow those patterns and catch an impulsive move, a correction, or a continuation. So I'm a swing trader looking primarily for technical setups. I run a advisory service, so I have a stock pick service. I call out signals on trades that I'm taking on my own account. People can follow along, hence the name Follow Me Trades. I also have some courses. I got a live trading room we run right at the open of the market for about an hour and a half each day. And again, some trainings and mentoring. So followmetrades.com. That's what I got going on. And I love trading and talking about it. This is good fun. So we're going to jump right into it. We've got a good list of symbols here. I noticed that SPY, DIA are both on the list. We're probably going to combine those and just take a look at one. They're moving pretty much in lockstep. That's, of course, the S&P 500 and the Dow ETFs. But first up here is an interesting chart, and it is SQ Square. So we're going to just go round robin here and have each of the panelists offer their thoughts. And, it could be that someone likes the trade and says, yeah, I like it long, I like it short, or I'm neutral, don't really know, or I absolutely hate it. Don't touch it. So whatever the case may be, we're going to hear about it here. And we're going to start with Jim on SQ. Where are you at on Square?
Well, real strong, obviously. Today it was up pretty good over 219. The volume coming into the stock is very strong on a 50-day basis average versus 200-day. So money's coming in and the stock's been going higher. The only thing that would make me concerned about it is its distance from the 200-day moving average. It's about 40% above its 200-day average. And after we saw what happened to the broad-based indexes when they got 16 to 20% above their averages, if the tide changes, it can be pretty fast. So, if I own this, I'd probably still hold it, but I probably wouldn't be unwilling to look at a collar strategy to protect some of my gains. And I'd respect the fact that it's very strong looking and the company is getting great news. But I'd be a little concerned about the possibility of it being a bit overbought.
All right. Bullish with, it sounds like some.
Yeah. I mean, it's bullish, but, like I say, it's not one of the greatest entry positions unless it's going to blow through 45. And then at that point, it's off to the races again.
All right. John, Square.
Square it is. Yeah, we have had a buy recommendation on this since July. Think it could double from here, but obviously with the peak in November and the lower peak 2 weeks ago, we're in a sideways time correction, which could last 6 months. Once we work our way out of that, I think you could get another double on this. We absolutely love Square as well as the entire sort of small cap financial area of which Square is one. And we even love the big caps like Visa. So bullish on this. And we are a dip buyer.
All right. Bullish on Square. I love their business model. I love their products. You can't go to a small business, a little small restaurant or something like that and not see their products. And not only are they selling hardware, but they sell services and get some revenue off of that. So I love their business model. I actually hate Roku. We've looked at it. It's like, how many of those can you sell, right? And you're competing with Apple and Amazon, really? But I think Square's got a whole different deal going on. I do have an MBA. I can't help but think about the fundamentals, even though I'm a technical trader. So I like it. I'm showing it. I use a combination of Elliott wave, look at impulsive moves, Fibonacci corrections, Fibonacci extensions, back that up with Ichimoku cloud. So we had, this Elliott wave 3, this big impulsive move that John caught. That's nice work. And then we had a nice wave 4 correction into a Fibonacci retracement, stayed above the 200. It's trying to put on a new rally, an extension into a target zone above $60, 60 to 75. I wouldn't be a buyer though until it gets at least above this last high that John talked about earlier this year, a few weeks ago, about 47, 48 bucks. We can take that out. It's off to the races, and I think it's worth waiting. You don't have to be impatient. Get in now. Let it put in a new high. Prove that the next uptrend is going, because you got plenty of upside potential. So I wouldn't sit here and let this thing go sideways and tie up capital. I would wait for the breakout, and then I would be a buyer on Square. I like it.
Yeah. This company's real competitors are Visa, MasterCard, and American Express, except Square is cheaper than everybody. By the way, we like all the other companies too. But if you talk to small businessmen, ask one thing that really drives them nuts. They hate paying those credit card processors, and Square is the low-cost entry here. So that's why we think there's a double in the stock.
Yeah, I think they got a good business model, and their stuff actually works. It's really solid. It's easy to use. You see it clipped onto phones and iPads everywhere you go.
Right.
It's cool. All right, next up, Avgo. Of course, can't do a show without talking about Broadcom, right? All right, Jim, where are you at on Broadcom?
Hang on one second here. I just was getting something here.
Broadcom
had all the good news there. What, about 2 months ago when he was meeting with the president and saying he's bringing all these jobs back to the U.S. and all that kind of stuff, and then it ran up towards 280, and we haven't seen 280 in a while. So this stock does look like it's on the defensive, and again, it's a situation where this recent drop that it had down into 225 would be your get out point if you wanted to be bullish. And if it rallied up, you'd imagine there could be resistance 260 to 270. So right now, I would say it's on the defensive a little bit here, but if you wanted to step in and take a stab at it, your get out point is what these lows were just recently.
Okay. Sounds like you're not as enthusiastic as you were about Square. Even
no,
that
because it looked like it's had its move above 280, and it looks like it's meandering now. And unless it really gets some fabulous news to get it going further, it could be rough getting through 270 and 280 in the short run.
All right. John.
Yeah, we like Broadcom for the longer term. We love the whole networking space. However, there are 10 other stocks we like more. So to find out what those are, you have to go to madhedgefundtrader.com. But if we could buy an 11th stock, we usually limit ourselves to 10 positions at any one time. This is something we would have been buying last Friday on the dip. So, again, the whole market turned on a dime on Friday, right above the SPY 200-day moving average, and the technology in general fell the least and then rallied the hardest once we hit bottom. So this is one of those sectors.
It's interesting you said they got hurt the least. As I look at the chart, Broadcom, the stock pretty much ignored what was going on the indexes for sure, right? You can't even see it on this chart. Starting on, early February, there was no big move out here on the Avgo. From a technical standpoint, what I see is, it had a huge run up, obviously, big impulsive move. It has moved under the Ichimoku cloud. It is under the 200. 200 didn't provide much support, but I think it could be offering some short-term resistance. And if I saw a sharp reversal as it approached the 200 up, the 200 SMA up around 250 and reversed down, I think we got a target short-term, few months, down between 220 and 180, and I'd be a seller on that. I would go short on a sharp reversal up at the 200 SMA. Long term, it's probably going up higher, but I think there's over the next few months the possibility of a good short play on this. And
one of the really interesting things about this correction is the meaninglessness of the 200-day moving average. Stocks either didn't even hit them or they blew through them and reversed immediately, just like Apple did. And I think that's a function of the dominance of algorithmic trading.
Could be. All right, let's take a look at ExxonMobil, XOM. All right. Jim.
Well, this one got slapped down in a big way here, and that spike down to 74 looks like it could be a temporary low point. So I'm kind of constructive on energy going further out in time. I know a lot of people are telling us that the frackers are going to be back and the oil, this and that. But I'm kind of on the camp that energy prices may be more constructive as the year unfolds. So if I was looking at Exxon here, it would be something I'd try to pick up and try to put a short leash on it at the lows that we just saw somewhat recently.
So short leash on it, what does that mean?
That means, if I was coming into this stock, I'd be buying it and I'd put a stop under 73 or so, and I'd try to, see if this thing could rebound back up as the year unfolds and pick up 4% of my money while I was waiting to see if it was going to pop back up, because it's yielding over 4.
Okay. John, what do you think about ExxonMobil? Got a tiger in your bank here?
I hate to sound like an Uber bull because I'm not, but man, this one is a screaming buy, 5% dividend, major support area. It fell more than any technicals or fundamentals would justify. Yeah, the price of oil went down $5, but you don't get this kind of move in Exxon on a $5 move in oil. So I'd be an aggressive buyer right here, right now.
All right. For me, as more heavily weighted to technical trading than fundamental, right? And Exxon's going to make money regardless of the price of oil.
That actually isn't true. A couple of years ago, when oil was at 25, they actually borrowed to meet their dividend because they were losing money on a cash flow basis. They are making money now, that's for sure. But I've been following this company 40 years, and they don't always make money. Sorry to contradict you there.
It's quite all right. A little agreeable disagreement is absolutely healthy. From a technical standpoint, I just hate this chart. It's chaos. I look for patterns. I look for impulsive moves, corrections, and continuations. And this has none of those. It's absolute random chaos.
Yeah. When you go from 90 to 75 in a week, where the heck is the pattern?
Right. So it doesn't meet any of my trading criteria. I wouldn't touch it.
Yeah. Yeah, I would touch this thing. It's down here. I would do this in something.
It's a value deal. It's a value deal. You think there's value? Yeah, and you're getting paid to watch the movie here at $20 under the high almost. So it's not the worst thing you ever did.
Yeah, I like Warren Buffett's approach to value trading. You can buy beaten down high quality companies, but it helps if you can put a guy on the board.
And it also helps if you can wait 5 years for a turnaround or 10.
Right.
He's always buying stuff on a 5 or 10 year view. So, and if it turns around in 5 weeks, which is usually what happens, so much the better.
Yeah. P's at 16. That doesn't sound expensive.
No.
But again, for me, we all got our different trading approaches. For me, technical. It's a chaotic chart. I don't want to.
No, yeah. The technicals, obviously, they broke way down, but they also broke way up. Back there in April and July. So
Yeah, you could get a huge return on this on a 70-75 call spread 3 months out.
If you're a believer in oil, I think also it comes into play. If you think oil at 60 is going back to 40, it's a do not play. If you think going back to 65, 70 or better is happening, then maybe it's a better play.
Yeah, you can do the same trade in oil. Do a 55-60 call spread in oil 3 months out. I would make more money on the equity.
I would rather trade oil because oil doesn't have operational leverage considerations. Oil is just oil, man.
Yeah.
Maybe this is a probability on Tillerson keeping his job in the State Department. Who knows, right?
Yeah.
It's funny.
This has to do with Aramco trying to keep oil up, going into the Aramco IPO.
Right.
Since we're talking about oil, let's deviate for a minute, just for fun. Indulge me.
I love fun.
If we look at oil futures continuous contract on a daily chart here, it has moved up from low 40s up to about 67, and this pullback, I'm watching this like a freaking hawk. Just from a technical standpoint, put all the geopolitical things aside, and Russia and Venezuela and fracking and all that. This is in a perfect retracement and looks poised.
It is
to take off up into the next move, and that next move, technical based, right? You start looking at the, again, geopolitical news and fundamentals. Your head can start to go around backwards, but this thing could easily push up into the high 70s on a technical analysis here if it finds a bottom reverses pretty quick.
Yeah, that is a classical technical analysis chart with a screaming buy. The retrace goes to the bottom of your little cloud there, but it also retraces to the top of the previous, head and shoulders move there. So this has just got buy written all over it. And if oil's going, so are all the other commodities, by the way, like gold, copper, and so on.
Soybean.
Soybeans, not so much. There you
No,
have
but
a weather element.
they're getting sneaky. They're above 10. They start getting above 10.50 or 11, and the next thing you know, something could be going on. But I agree with you. There's there's a lot of supply out there, South America, but it it generally does do something. Though in the last year or so, it hasn't done much. But it is one of the more volatile grains, that's for sure.
Yeah, 5 years on the grains, and the technical setup could be great for soybeans, but what if it rains?
Exactly. Then let's hope it doesn't rain.
If you're long.
All right, we'll pull ourselves back to the agenda here.
That's right. That's right.
SPY, S&P 500 ETF. I think it's completely fascinating, but I'll wait my turn. All right, Jim.
Yeah, well, we had I mean, like everyone's, the whole world is saying we hit the 200-day average and it held, so we're out of the woods now. That seems to be the chorus out there. And it did go down to that 25-30 area and then bounced up really nice. I think right now, in my view, the 27.30, 27.65 area are the two key resistance points. It'll be very interesting to see if that can be exceeded. And as far as as far as anything else is concerned, I think with the VIX trading between 20 and 40, the market is kind of going back and forth, trying to settle down after really being smashed over the head with that VIX jumping to 50. So when the market's meandering like this, is not one of the better environments that I like to mess around with. So, again, if it went up to 27.30, 27.60, that would be interesting. And of course, if we go down and get anywhere near the retest area, that'd be interesting. This middle area is a rough racket to really make any big definitive statements. Although you have to say that the trend is still intact for the upside. There are some things going on that might change that.
All right. Can't wait to hear John's take on the S&P.
I hate to be such a conformist, but I completely agree with what Jim just said. 200-day moving average, and it didn't quite hit it, by the way. It got to within a couple of points of it, but never broke. I would look for it to recover half of the recent loss, which it almost did. We could be setting up here for this is almost like the square chart. You could be setting up for a 6-month sideways narrowing triangle, and then a breakout to the upside, as long as the fundamentals support it. So the range for me is the 200-day on the downside, the 50-day on the upside, which is right around 266, exactly half of the move. So there's your trading range for the next couple of months, my bet. We bought like crazy at the 200-day on Friday. We were selling like crazy today, deep in the money puts, buying deep in the money put spreads as we approach the 50-day. That range is so clearly bracketed, and you can bet the whole world's going to trade around it. So that means we're stuck in this range for a while.
All right. Ask me what I think of the SPY tomorrow at 8:31 Eastern.
Yeah, right.
So, of course, we got the CPI number coming out, and, that's all hands on deck to see. The number will be interesting, but it's,
we're going back for another 200-day. If we get a guy, which I think we'll get, that's what the bond market thinks anyway. The tax cuts haven't had time to take effect. They haven't had time to superheat the economy. So I think we're going to stay with cool inflation numbers for at least a couple more months. And if that's going to drive all trading for the next several months, there's your answer. Eventually, inflation does come back, but it could be a wait.
Yeah, the 200-day moving average on the 10-year is 2.35 ballpark, and we're trading up at 2.85, which is 40% above the 200-day. So not unlike the stock market at 2,900, a report like this could send the bond yield dropping sharply and get a bond rally that people are just totally not ready for. That could happen.
By the way, I'm ready for it. I
Well,
am
I'm just saying,
long the bond market.
most people are high interest rates. So the whole world's high interest rates.
Yeah,
What a
it's in
great,
the price.
what a great time for a bad CPI number or a weak CPI number and get Tom, Dick, and Harry covering. I mean, you could get the 285 down to 265 very, very quickly, I think.
Yeah, and let me tell you something really interesting if you're comparing stocks and bonds. The market crashed on the fear of rising interest rates. You know, the only thing that didn't happen in the last 2 weeks, interest rates didn't go up. They've been flatlining for the last 2 weeks.
Yeah, in the 280 area. Yeah.
And that tells me that bonds are way overbought. You know, the yields have just had a huge run since July from 2.03 up to 290. I think they're overbought for the time being. And you know, a lot of bond big boys like PIMCO, they see the top for the year at 3.25. So there isn't much juice left on this short bond trade. And if anything, it's a better long now than a short.
And this report could be a catalyst.
Only if you get a big number one way or the other.
Yeah, I'm saying if you get a lower number.
I'm wondering if if you get a flat number.
Yeah.
Even a flat number, I think stocks sell off because people are so hyped up on the interest rate story now.
Right. Retail sales come out tomorrow too, which is a forgotten subject, and I think that's kind of important what that number might say.
Well, we're after Christmas, so it's less important coming out of the Christmas season. But yeah, retail sales should be hot because even though most people don't get their tax cuts for another 15 months, they're spending it now.
Right.
And you'll see that in the retail sales. Certainly that was the story over Christmas.
So you guys are familiar with the paradox of the prisoner's dilemma?
Yeah.
Yeah, so I'll recap it for any listeners who don't know. So prisoner's dilemma is this awesome paradox. It's used in a lot of studies that two friends actually have done something wrong. They get arrested, but the police have no evidence against either of them. But they put them in separate interview rooms, and they say, hey, if you rat out your friend, you'll be punished, but you'll get a better deal. And the other one will get punished more. And they tell them both that same thing. And so the optimum strategy is to keep your mouth shut because the police don't have the evidence. And if you keep your mouth shut, right, you're both going to walk out of the police station. But in every simulation, right, they end up ratting each other out and they both get a worse sentence and a worse outcome than if they kept their mouth shut. And I think the market's just like that, right? Everybody's worried about what everybody else is going to do, right, rather than just trading the realities and the fundamentals. And the big crash was all based on that because, like you said, John, nothing changed, right? Really?
Yeah.
But it's everybody's worried about what everybody else is going to do. It's the prisoner's dilemma on steroids. And so I think the information tomorrow will be super interesting. On the SPY, I think, so here's, I think it's going down. But I've been thinking that for a year. So I don't trade based on what I think should happen or is going to happen. I trade based on the realities, what's actually happening. And if we break and close, we actually did wick down through the 200. We didn't close below, but the intraday went down below the 200 on the SPY. If we get a good solid close below the 200, after coming up to the cloud, hitting some resistance, reverse down, get a close below the 200 SMA, then I'm going to shift to the weekly chart here. And for me, that's going to signal that the long overdue correction could be on. And it's got some room to the downside. Takes the SPY down to a midpoint of about 200. I'm not ready to call that yet, right? I need evidence. I don't trade based on what I think is going to or should happen, but rather what is happening. And a close below the 200 here will signal it's happening. But we're not there yet. That's my take on it.
Yeah, my only problem with that is you've never had a bear market when you had the hottest economic data in 15 years. So that's what's keeping me towards the bullish tilt on everything.
Here's a question. I got a question for you, John, that might be interesting. Abby Joseph Cohen came out today, and she's worried about valuation support looking forward. And she's saying the policies and the budget and the trade and the infrastructure is not going to be helpful for valuation support. And she has concerns looking forward. And if the market would join in her concerns, since it's a discounting mechanism, could that be where some of the headwind would come from? Because
Well,
we did roll over exactly when he spoke.
well,
State of the
all of
Union
those
address was the
headwinds are
high.
going to hit, but I don't think they hit until next year.
I got
You
you.
know, my conclusion on the whole tax package is that we get a higher high first in the market,
Okay.
sometime in 2019, followed by a much lower low afterwards when higher interest rates, inflation wipe out all the benefits of the tax package. That
Okay.
is a certainty. The only question is how long it's going to take for that to happen, whether it's 1 year or 2 years. And Abby Joseph Cohen is notoriously early by 1 or 2 years on her calls, by the way.
Right.
She's not a trader, you know, she's a
No.
long-term
Right.
philosopher, let's call her.
And
I like that.
one other question, real quick: the suspending of the debt ceiling until March of 2019. In
Yeah.
your view, important, not important, not an event? Could be
It's very important on so many levels. The fact that the, you know, Republican Party has flipped on their debt position on really a 50-year debt position is terrible news for everything. Stocks, bonds, commodities, you know, the price of Beanie Babies, you name it. But it'll take a year or two to digest that and for it to be reflected in financial markets. You know,
it could be a factor to the longer term view you were talking about.
it will be the instigator eventually.
Right.
But, you know, it takes time, you know, for these things to turn.
Right.
You know, I remember the last big debt explosion we had, which was in the 80s. And, you know, the beginning was exactly like this. You know, everyone was going gaga over stocks. Bonds got slaughtered, but eventually you got the 1987 crash. So down 22% in one day. And I think we're heading for one of those, but it's a ways off. In the meantime, there's plenty of good money to make in the markets. Just don't go naked short volatility.
Amen. Amen to that.
By the way, we shorted VIX on Tuesday morning at 39, which is the first tradable point you could sell VIX. And we're down to about 25 now on the VIX. So that is your new trading range, I think, on the VIX is, you know, it's going to be, let's say, 35 to 20. That's a fabulous range. You can make a ton of money on that. The time to sell VIX, time to sell insurance is after a hurricane has come through and wiped out all your competitors. That is the situation now with VIX trading.
Let's pull it back to the symbols here and keep marching through.
Sure.
Cool conversation. We could go on all night, but let's take a look at Barrick Gold, ABX. You're up, Jim.
Well, I thought constructively on this, but it seems to be very much a dullard. So, you know, other gold stocks like Gold Corp seem to be a better, let me say they have better legs right now than this one here. But all of them seem to be a bit under pressure, even though gold was kind of firm today. So, you know, there's not much exciting going on with this stock because it tried to get above 15 and kind of failed. And so at this point, if you want to be bullish on it, I think you might be better to be bullish as it breaks above 15 and leave it alone. That spike low we saw the other day at 1250 could be a defensible low point. But, you know, like I say, it does, you know, since I do have a feeling that gold will have a good year as the year progresses. Similar to oil, both oil and the gold stocks, Exxon and ABX should be getting married because they both basically have done the same thing, go way down, and they had a little bit of a spike low, and now they're trying to turn. So I would say, again, if you're long-term bullish on the metal, this is not a bad place to get in. And then, of course, if you don't think the metal has much of a future, I'd stay away from this thing.
All right. Barrick Gold, John.
Yeah, we like the gold story. We think it got kind of postponed by margin calls on everything else in the world. We actually had a double long position in gold going into the crash, and that really saved our bacon because gold barely moved in the first week of the crash, and it was only when the margin calls hit that they started to sell it off. If you're going to play a gold stock, I'd avoid Barrick Gold because they have a big debt problem from a lot of borrowing they did during the last expansion 6 years ago. My favorite in the area is Newmont Mining, which is the largest gold miner in one of the largest gold miners in the world.
All right.
John, what do you think of the leasers like Wheaton Precious Metals?
You know, we absolutely love Wheaton. We've been in and out that many times over the decades.
Yeah.
They have a fantastic leverage business model when it's going up.
Right.
So I put a couple trend lines here on Barrick Gold. You know, there's a larger downtrend and there's an accelerating downtrend. It's a pretty volatile chart. I like gold. I am actually long gold, right, with the ETF, GLD. I think we've got signs of the next leg up on gold, and it looks really positive. But there's more to a gold company, as you guys have pointed out, than gold, right? There's a lot more issues with gold miners or gold concerns.
And you know what's really interesting on this chart of Barrick, it's almost the exact opposite of gold itself. And the reason is that big debt problem that I referred to earlier.
It's interesting that you mentioned Newmont. I've traded Newmont many times. I like it. And I'm watching kind of my favorite gold company is McEwen. And I'm waiting for an entry on McEwen. They got to put in a new high at 256. And if they do, they could be off to the races up above 440. Kind of like these lower price, smaller cap ones. You can make a ton of money if you get it right. But I like gold. I'm just trading GLD, man, on a 60-minute chart.
Yeah, GLD is the best of the bunch, really. You know, you don't have to worry about tracking error that you get with the miners. By the way, bonds are at 282 on the overnight market, so they're starting to agree with us on what this CPI may be about.
So I got into GLD at 125.48 Monday, and we're looking for a target of 131 or above. And we're in a little bit of profit.
That's a good trade.
That is a classic Elliott Wave 5 setup right there. It doesn't get any clearer, doesn't get any higher probability. We are letting this baby run.
Yeah.
Trading. And, you know, I don't know what the option professor thinks, but for me, when you got a clear directional trade, high probability, for me, the highest profit, lowest risk strategy, go buy the calls, baby. Go buy the calls. High delta, deep in the money calls. About 120 days out, let those things run for a month or two. That's what we're doing.
I would totally go with that.
We agreed on something? That's awesome, man.
We can agree on almost everything. That's because you're only showing me your best charts and saving the crappy ones for that other service.
Okay, where are we at? Oh, you know, we missed MGM and Freeport. Freeport's going to be another disappointing miner. Let's look at that now while it's on my lips here. I just think there's better gold plays than Freeport, better mining plays than Freeport, personally.
Well, Freeport's heavy in copper, so that's a little different ballgame.
Yeah.
But MGM is an interesting company with what's gone on at Wynn Resorts, right?
Let's knock out Freeport and we'll go look at MGM.
Okay.
What do you think of Freeport, Jim?
Well, I mean, I still think it looks constructive, and I think that 200-day average you're showing right there would probably be about as far rope as you'd give it. I think isn't Carl Icahn still pretty much in this thing? And,
he is. He hasn't announced he's gotten out of it.
Yeah. So I mean, he's in there trying to make some money with it. And, if the gold and silver and copper go on the runs, then obviously taking out 20 and getting off to the races further might work pretty good. But you've got a pretty good $14 line that goes across all the way. And that would be a good line in the sand if you wanted to be long this thing.
Man, I love the volume on it. It's deep and wide. You in on Freeport, John, or hands off?
Yeah, we had a Freeport position. We got stopped out of it like the second day of the crash, and looking to go back in. And if you think it looks too expensive because it just has gone from 3 to 20, I will remind you that the old high in this is $50 at the top of the last commodity bubble. So 20 back to, 16, that looks like a good entry point to me.
I like some of the other ones. I like just gold, GLD better. Like I said, I was looking at McEwen. But by the time this thing would prove it's heading up for me, it's already pretty close to the target. There may not be enough potential. But I'm on a 4 to 6 week time frame. I'm not out months, and months out in the future it could be even better. But so for my parameters, it's not that sexy. Let's go ahead and go back. We're out of order here, but we'll get back in sync here. MGM, Jim, you were talking about this. What do you?
Well, I was listening to, I think their Asian or China director over there, and he had all kinds of things that they were doing with high-end gambling in a bunch of different areas over there. So, it seems like there's a lot of support around the 30 number. And I don't know if they're going to be able to steal business from Wynn or not. But if they can, and they can hold the 30 number, then this thing may have a decent future to it. Particularly if the gambling keeps growing and growing and growing in China and all around the world.
Okay, John, the Roaring Lion, MGM.
Yeah, we don't really participate in the hotel industry, but just looking at that chart, if you like this sector, this is absolutely a great entry point, with the 200-day down there and this massive sell-off just having taken place. So I'm a Bellagio man myself. The MGM is for a younger crowd than me.
But I think Bellagio is owned by MGM, so that's good.
No, well, are they now? Because it was originally built as a Wynn hotel.
Yeah, no, he sold it.
Okay, yeah, I remember thinking he was crazy when he built it, but I couldn't remember that it was sold.
Great hotel.
Yeah.
So it is finding support at the 200. I don't like the setup. I don't think the sector is that great myself either. I'm not participating. It does look like it may reverse pretty quick. Excuse me. Couldn't mute fast enough. But yeah, I'm not interested in it. It's not my thing. So let's take a pause here and talk about what we do like. We've offered insight on a good number of symbols here. Let's talk about what your favorite trade right now is. May not be on this list. And Jim, what do you got your money in?
Well, I'm kind of getting a little bit interested in the commodity sector. So stuff like the gold you were talking about would be something that would make some sense. And might not happen right away, but I think this meandering on gold between 1350 and 1200 back and forth, when it does come out of there, it could go up pretty quickly and pretty fast. And the energy sector is another one that is on sale right now. So if you're a believer there, you're getting a discounted price. And I just was looking at Mosaic and seeing if there's something happening there, because that's another one that could be benefiting from the overall activity here. And that's trading in the 25 area. And, again, it's pulled back. So if you are a believer in these sectors longer term, then you are getting a little bit of a discount on the prices with the pullback. And those would be some of the things I'd be keeping an eye on.
All right. John, give us some sugar, man. What do you like?
Well, my favorite things were the ones that I bought on Friday, and Apple was one of them. We got Apple just above 150 on that capitulation move. Unfortunately, that move happened so fast you could only get a couple of trades in. The other one we got was Amazon. So, given the choice of buying two, It was those two, and I'd be looking to buy those on dips. They both had big runs already, but I'd be buying the dips on those two.
Okay. My favorite trade right now, I hate to say it's too late to get in, but it's TLT. We're short TLT. We've been short since 122.41. Our stop is now inside. So, and we've taken profit down here at the reversal. So guaranteed winner trade. Now we're just going to let it run and see how big it gets. And I think good probability of getting down to a wave 5 target zone below 113. And once it gets some momentum, you can see like it did back in 16. If it gets some momentum down, that baby can rock. And it's just getting started. So target zone, these green lines, 113 to 104. We're in profit, guaranteed winner, love it. Too late to get in. My favorite trade right now is the gold trade I showed earlier on a 60-minute chart, GLD. Just getting started, plenty of profit potential left. I think it's going to rock. All right, back to the list. Let's look at Adobe. Company the only company I hate more than Apple is Adobe. In terms of doing business with them as a customer, they suck. Their business model, from a consumer standpoint, is terrible, but they're apparently making a lot of money. What do you think of Adobe, Jim?
Yeah, I'm just taking a look at it. Give me 1 second to get this thing off here.
Yeah, I like it. You know, while you're checking your charts,
Right.
you know, we like the software suite they have. They're growing with the rest of tech. It maintained the uptrend line in the latest sell-off. So, you know, along with the rest of the world that we were buying on Friday, you can throw Adobe in there.
Yeah, it certainly looks very much similar to the ones you were talking about, Apple and Amazon. You know, pullback of about 10% and a little bit of a spike low to 180. And so obviously it looks like it's back on the bicycle right now.
Yeah, I couldn't buy it or short it at this point for me. A little late to be going long, I think. A little early to be going short. So nothing cooking. Home Depot.
Yeah, but a lot of these trades, you know, unless you had the guts to commit on Friday, we are in the middle of nowhere land right now. We're right in the middle of recent ranges, and you don't really want to do anything here until we reach, you know, one end or the other of that range, no matter what the stock is. And we could be stuck here for a while, like a couple of months.
Mm-hmm.
I agree with that. Home Depot. I haven't looked at this chart in a while. It's kind of interesting.
It's pretty. Yeah, it looks kind of like the S&P. You know, got slammed there and made some spike lows around 175, and now it's bounced back up. So if you like Home Depot, you want to take a shot. I think you're line in the sands right there at the 175 mark. And if you are in it and it rallies, you know, it looks like a reasonable thing to collar. You know, because that 205 area, you know, could hold up for a while.
All right, John. Home Depot.
Yeah, this has been one of our core longs for 2 years. We sold it the end of last year when everything started going crazy. You know, I'd be a buyer on dips. You know, there still is an extreme structural shortage of housing in the United States, and this is your classic fixer-upper stock.
And housing has gone up, and a lot of people haven't put money in their houses in a long time. So that makes sense that they'll be going down there and fixing it up. I can tell you personally, I've been down there doing a whole bunch of stuff. I think the fixer-upper place is going to be, it has been and continues to be pretty good.
Yeah, and they're an extremely well-managed company. You know, even without the major tailwinds, this would be a buy. But, you know, structural tailwinds, and this is going to go on for like 5 more years. I mean, there's going to be a housing shortage in the U.S. for at least 5 to 10 more years because so many shut down during the last crisis.
Home Depot has their act together. They are an incredibly well-managed company.
Yeah.
From a technical standpoint, you know, with they had a nice wave 3 up, big impulsive move. Their correction found support right at the Fibonacci retracement levels. We could see it take off into the next big leg up, and it could be super big. The Fibonacci extensions on this, pretty shallow 4, take this thing up over 227 to 260, and that could be real. They're a great company. They're my go-to for sure. I am contributing to their bottom line in a very big way. I'm an empty nester, man. So just recent empty nester. So we're just redoing everything, and they're getting all of our money.
Yeah, make your house smaller so the kids can't move back in.
Well, I'm projecting right now from. This is awesome. Let me go back. Stop sharing. So the oops. How do I stop? This is important. Okay, so I am projecting from the 19-year-old's former bedroom. So this is now my office. There's no room for him to come back to. It's like, dude, there's a guest room for a day or two, but your room is gone. So I think that's the right strategy, right? Okay. Disney. Didn't Eisner quit? Disney announced he's out of there, and Disney just raised gate prices on their theme parks.
Yeah, they are. I don't think Eisner's quit, but
He's announced
prices.
No, I think he's got another year or so, doesn't he?
Yeah, I think he announced a year or something out. Yeah,
they're also unleashing dozens of robots at all their parks now to go talk to people.
I can't wait.
And didn't they put something together to challenge Netflix too, right? They put some package together to
they are
challenge
taking.
Netflix.
They are fighting back the Netflix thing, and
Right.
they've announced they're building their own in-house Netflix essentially. So we, the consumers, should do really well off this coming battle.
A lot of these stocks look like if the S&P is going to hold at 25-30, they're all going to rebound in unison.
Exactly.
And if it takes out the 25-30, you can stick a fork in a lot of these things.
For sure.
Disney for me is this is an incredibly sloppy chart. It's a cool company. It's a sloppy chart. It's more of a day trading instrument for me than I'm a swing trend trader. I don't day trade. And in terms of a longer term swing, trend trade, there's nothing here for me. It's a mess. But it's a volatile thing, and day traders probably love it.
Yeah, the interesting thing that this stock has basically gone nowhere in a year, but the earnings keep going up, and the concern is ESPN is just disappearing, and that was a major part of their earnings.
Yeah, because most major events are not on ESPN.
Yeah, and the P now stands for political, and that's not what people tuned in for.
Yeah,
they shot themselves in the foot.
They should have kept Chris Berman. That's what they should have done.
Well, they should have focused on sports, maybe, right? This is sports channel.
Right.
Cat.
You guys want to do one from the audience real fast? Facebook.
Yeah.
Facebook, FB.
Oh, of course.
It's been about a month since we've talked about it on here.
Super interesting.
Facebook is taking over the world. That is another stock we bought on Meltdown Friday, and but we also bracketed it by going short the 190 or buying the 190 195 put spread, and the concern there is that they're changing their business model,
right?
Trying to control content more, and the concern is that that'll shrink ad volumes and hurt the business. So far, it hasn't. Their it isn't trading as well as the other FANGs. I'll put it that way.
No, there does seem to be a different vibe to it right now.
Yeah.
I got a 19-year-old kid, and he and his friends, Facebook is done. They're done with it, right? That's old people stuff.
That's what I hear. Yeah.
Snapchat, Instagram,
yep.
And that's what your parents and grandparents use is Facebook, and now they're changing the business model, and it's super interesting to have senior execs, former and current, coming out and saying, we think we built something kind of evil.
Facebook owns Instagram, though.
Are they
So
different?
the people are going to another product. Yeah.
On a technical standpoint, it's starting to break down. If it can get a close below the 200, say, you know, a good solid close down below 168, I'm short.
Yeah.
I'm going short. And, you know, the impact of their changing business model, which is basically gouging and undermining every business that they encouraged for the last 10 years to build a following just got shafted, right? And they said, well, the only business feeds that are going to show up anymore are paid. Thanks for your effort. That may not go over that well. So we'll see.
Right, but where else are people going to go?
There are other channels. Actually, Twitter is actually profitable. YouTube is a way better content marketing source than Facebook currently for me. So I'm a little skeptical, and I wouldn't mind.
Twitter's about 1/10 the size of Facebook, and has nowhere near the network and the community that Facebook has built. The trouble is Facebook is so big now, they're almost a quasi-monopoly, and that's really hard to break into.
Yeah, you know, they're big, no question about it. I think they're generating some real ill will with their advertiser base, particularly the smaller businesses, which are bigger in number than the big players, right? So we'll see. We'll see.
Yeah, the volume's been picking up a little bit on the declines too, so people are seemingly more willing to dump it than they were.
All right, where are we at on time? Well, we're out of time.
At a time.
We didn't make it through the list, so this is where we come around to a wrap up, final comments, and if there's anything you wanted to share with people, this would be the time. So, Jim, closing thoughts, anything you want to share?
Yeah, just with regards to the volatility that we just saw, that could be bleeding over into many different markets. And so it's not a terrible time to be aware of a bunch of different strategies in the options on things that you own, the married puts and the collar strategies, to try to give you some parameters on what the values of your situation will be. And then, of course, on the inexpensive options or the low volatility options, to get an idea on how to do limited risk trading with leverage. And then, of course, for cash flow creators, you know, how to maybe create some cash flow on some of your positions as well. So these strategies are in depth, and that's where the Option Professor DVDs come in real handy. So optionprofessor@gmail.com, and just let us know, and we'll be more than happy to send something out.
All right, very good. John, closing thoughts from you?
Hey, David, can you pop my 2 slides up there? We're at www.madhedgefundtrader.com, cover all asset classes, long and short, up 8% in this incredible year so far. And we're looking to top the 58% return that we made for our followers last year. So we also have the Mad Hedge Technology Letter. If you want to focus your investment and options trading in specifically technology-related names. And, you know, here in the San Francisco area, you breathe technology. It's around us all the time. The investment opportunities are fantastic. The more you dig into things, the more you find. So Mad Hedge Fund Trader and Mad Hedge Technology Letter, and I look forward to working with you.
All right. And again, I'm Dean Jenkins, followmetrades.com. Here's my website. And easy way to find out more is just to sign up for my free newsletter, Beyond the Noise. And each week I give an update on the market and key commodity things. And hopefully you'll be either have or getting an invitation. John and I are going to spend some time tomorrow taking trades, arguing a little bit, maybe arm wrestling, agreeing on some stuff, not on other stuff. But that's going to be a fun session too.
Boy, you look so serious in that picture.
I know. I know. That was what the photographer thought would be good. I'm not sure. But anyway, hey, very good to be here. Thanks. It was fun hanging out with you guys, talking about trades and getting some good ideas. So, David, back to you if you want to wrap it up.
All right. Thanks, guys. Just a reminder for everyone watching. be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, for next week, the Crowd Forecast News, the Monday show, will be off next week because of the market holiday. But Analyze Your Trade, episode number 24, will be on Tuesday, February 20th at 9 p.m. Eastern Time. Just want to thank my guests again for this week. John Thomas of MadHedgeFundTrader.com, Jim Kenny of OptionProfessor.com, and Dean Jenkins of FollowMeTrades.com. Thanks, guys.
All right. Thank you, David.